Hello everyone, and welcome to the Textbook Ventures and Folklore's Venture Capital 101 event. My name is Saurabh, and I'm the General Manager at Textbook Ventures. Textbook Ventures is a student-led organization dedicated to inspiring students to embracing entrepreneurship and be catalysts of change. We run events, case challenges, and digital content to encourage students to explore a career in tech, startups, and VC. TBV is extremely lucky to have Folklore Ventures as our sponsor for 2021. Our first major collaboration is on the Venture Capital Case Challenge that kicks off next week. This challenge gives students the opportunity to step into the shoes of a VC investor, analysing 3 different startups and presenting their findings to the team at Folklore. Not only will this be a great learning experience, but the winning team will also get the opportunity to do a week-long behind-the-scenes internship at Folklore. Today's VC 101 event is a primer for anyone keen on getting involved in the challenge, but is also aimed at anyone in the broader startup ecosystem that wants to understand the basics of venture capital, led by Dan Fleming from Folklore. I'll now pass over to Jess, who runs Growth Ops at Folklore, to say a few words.
Hey guys, it's Jess here. I'm the Growth Ops Manager at Folklore Ventures. So Folklore are an Australian venture capital firm with a first check to forever investment mandate. So our vision is to be able to create an abundance of opportunity for future generations. And we do that through not only the companies that we invest in, but the long-term way that we partner with and support those companies and their teams as they go on to build the success stories of the future. So we are super excited to be partnering with Saurabh, Elha and the Textbook team because we just 100% back their mission around sparking entrepreneurship as a viable career path and creating those catalysts of change. Because whether you want to be a founder, whether you are a founder, whether you want to work for a startup, whether you want to be an investor, we think that the more students that rally around the Australian startup ecosystem, the better, not only for the ecosystem, but for Australia in general as we look to create more future opportunities together. So thank you for the Textbook team for having us on this journey with you. We look forward to putting on some really awesome programs together and super excited, of course, for this kickoff event for the VC 101 session in the case challenge to hopefully get you guys a bit under the hood around what it's like to be a VC investor. So I'll hand it back to you, Saurabh.
Thanks, Jess. Thanks for that intro. So let's kick things off. I'll pass over to Dan to introduce himself. So over to you, Dan.
Cool. Thanks, Saurabh. Hey, everyone. So my name's Dan. I'm an investor at Folklore Ventures. Bit of background on me. I'm a UNSW alumni, studied economics, and then took the path into accounting and consulting before taking a break from that and moving over to the US to play rugby for a season, and then was lucky enough to continue that rugby journey over in Hong Kong for a year and kind of realized that dream, and then moved back to Sydney to join early stage startups as an operator. So jumped into a pre-seed IoT company called Ragtagged, essentially helping parents and families solve lost property at school using RFID tech. That was a really gritty journey. Scaled that business from about 7 schools to around about 120 schools in the space of 7 months across Australia, which was a great look into what lean operations are like in a kind of a pre-seed startup. And then found my way over at Legal Vision, which is a legal tech business in Sydney, post their Series A. Different experience working with a well-capitalized startup looking to scale operations. So I sat in their growth ops team and was just solving strategic problems across the business, really focused on unit economics and scaling the sales team. So did that for a bit of time, and then found my way to Folklore about just over a year ago. So I sit in the investment team alongside Alistair, Hannah, and Andrew, backing the most ambitious founders in Australia and New Zealand, and looking for the great next success stories of our time.
Awesome. Thanks for that intro and sharing a little bit of your story, Dan. I guess to get stuck in, a good broad place to start would be, what is venture capital exactly, and how does it all work?
Sure. So in simplest terms, venture capital is just providing money to startups with high growth potential in exchange for an ownership of the company, known as equity. Startups tend to follow fundraising cycle. So you may have heard of like pre-seed funding, seed funding, Series A, Series B onwards. And essentially a startup will go through those funding cycles as they mature. And venture capital acts as that delivery of capital, or like that investment injection at each of those funding stages. And that's effectively how they play the part in helping startups grow.
Right, makes sense. And then how does venture capital as an asset class operate? How are these funds structured?
Yeah, so when you think about, well, firstly, when you think about venture capital funds, you can categorize them in lots of different ways. So you could think about them in terms of what stages they sit within the funding cycle. And probably the best way to anchor your thinking there is around uncertainty, business maturity, and investment required. So Folklore Ventures, as an example, we sit at the really early stage of funding cycles. So investing at pre-seed, seed, and Series A. And when you look at those kind of stages, so pre-seed effectively is the highest uncertainty, probably the business maturity is in its most infancy, could just be an idea. And the investment required is small. And then kind of as you move up to seed stage, that uncertainty decreases, albeit extremely high still, and businesses start to get some early traction and might have some customers and early team. So when you think about VC as an asset class, you kind of can think in the fundraising cycles, and then you kind of move into later stage, and there's venture capital funds that move to later stage. To your second point there around like how it's structured as an asset class, the best way to probably think about this is in terms of who invests in VC, who runs VC, and then also how we make money. So essentially, as an asset class, there's limited partners that invest into a venture capital fund, and they're known as sophisticated investors. So that's generally high net worths, family offices, institutional investors like super funds or corporates off balance sheet. And they are the limited partners. And then the general partners are the people who run the VC fund, and they are experienced operators that are essentially stewarding the capital for the limited partners and making investment decisions. And then how a venture capital fund makes money off the back of those investment decisions is what's commonly referred to as a 2 and 20 model. It's the general kind of scheme for investment capital funds. And that 2 and 20 model is a 2% management fee, which is effectively out of all the pool of funds that limited partners have allocated to a fund. The VC will take a 2% clip of that to effectively operate the business, hire employees, rent, that kind of thing. And then a 20% performance fee is effectively the reward of making great decisions and hopefully making substantial returns. And essentially that's a 20% percentage above a certain level, which is referred to as a hurdle rate, and you get 20% on top of that surplus.
Right, so that 20% only kicks in when the startup exits or is sold, goes public. Is that correct?
Yeah, so typically, what in terms of liquidity for venture capital is generally quite scarce. So you expect that it'll be a 7 to 10 year period. And when a venture capital fund starts to realize returns is exactly how you said. So on an exit event, that could be IPO, trade sale. It could be a venture capital fund selling their stake to another fund at a later funding stage. And that's when you kind of start getting returns back to the fund and can start distributing to LPs, depending on the level of in the mandate.
Got it. That makes sense. And
yeah.
I think one more thing I'm curious to understand is just what makes VC different from, say, other investment asset classes, like say private equity, infrastructure funds. What differentiates them? Yeah,
sure. So when comparing to private equity, it's a pretty close comparison. So both private capital investing into private companies. The main difference really, there's a lot of differences, but some of the kind of the quick differences is around timing. So essentially, venture capital, you tend to be going earlier higher uncertainty in the business. So you're holding on to this capital and these returns for a longer period of time. So 7 to 10 years, as I mentioned. So liquidity is quite scarce. For private equity funds, they tend to be sitting later stage, albeit we're starting to see private equity funds start to creep kind of earlier in the funding cycle, but tend to sit later stage. Returns back to their LPs generally sit between 3 to 5 years. So that difference in terms of business maturity is a significant one. And then probably the only other relevant asset class to compare to is, most commonly known as, or the most common probably asset class for most people is public equities. And the big difference there is largely in, access and liquidity. So anyone can, buy stocks and trade stocks, and the liquidity for returns and positions is really clear and transparent and available. But then for venture capital and private investment, it's restricted to sophisticated investors mostly.
Got it. That makes sense. And would you be able to share a bit about the state of VC in Australia currently? How long has the field been active in Australia, and what does the future look like?
Yeah, sure. So I'd say most people agree that Australian VC is still very much in its infancy. So it's been operating for around about a decade, and then kind of when you compare that to the US landscape that's been around for multi-decades, you can kind of see where they are, and see that we're now first quarter of growth effectively. However, it's a super exciting time in Australian VC at the moment, because there's over 50 companies that have 100 million plus valuations, and we've got numerous unicorns that are Australian born, Airwallex, Canva, Safety Culture, just to name a few. So what that means is that there's a lot more capital kind of flying into the Australian VC and startup ecosystem. That's because there's more funds, but also there's a lot more operators, whether they've worked at a number or a few of those exciting high growth companies, now have realized returns for themselves and are filtering that return back into the ecosystem. And it starts to create this flywheel of capital and talent into Australian VC. And then I'd probably say from an operator's lens, the veil's been lifted on startups and VC in Australia, and people are looking at it as a viable career path. So we're just getting higher quality operators to dive into new startups to kind of help founders build companies. So I'd say it's probably the most exciting time to be creating and starting companies and joining early stage companies in Australia.
Awesome, really exciting, particularly since we have quite a few students in this course. So hopefully they'll be the future venture capital investors in the next
fingers crossed
10 years or so.
Hope so. Yeah.
You mentioned that so Folklore sort of sits at that earlier stage of the investment life cycle. Would you maybe elaborate a bit on Folklore's investment thesis as a whole?
Yeah, sure. So we're a first check to forever VC fund. So essentially we want to invest as early as possible at that pre-seed stage. It could be pre-revenue, pre-product, and we want to follow that journey of that startup for as long as we possibly can, and effectively become this long-range capital machine. In terms of our focus, we're primarily focused on B2B SaaS. However, we have the flexibility in our mandate to invest outside of that. So really excited about the next wave of robotics and automation, and equally really focused on any startups that are leveraging advanced technology, so AI, machine learning, NLP. And from our existing portfolio in Fund 2, you'll see that application has been broadly applied to healthcare. We've got 30% of Fund 2 in that space, and that's not intentional by any means. It's just because healthcare is a huge space, lots of different verticals, and so much room for advanced technologies to improve how healthcare is delivered. And kind of adjacent to that is this workplace productivity, future of workspace that is really starting to kick off, and also is like along the ed tech lens as well. So anything playing within that B2B SaaS space, utilizing advanced technologies is exciting to us.
Awesome. And would you be able to share some examples of companies that have are in the Folklore portfolio and how those investments came about?
Yeah, sure. So one of the most recent investments we made was in a pre-seed technology startup called Ali Health. So we invested in them at the pre-seed stage last year. Essentially, Ali is solving addiction recovery through software. And at the time of investment, it was investing in the opportunity alignment on the market in terms of addiction recovery is fundamentally broken in terms of the amount of time that people are going through addiction and trying to recover versus the available support in rehabilitation centers and whatnot. So we felt that software fundamentally could play a part in improving and supporting that journey. And I think at that stage, that early stage, you are really leaning on the team. And Sally Krebs, who's the founder of Ali Health, is one of the most impressive founders I've ever met. And the clarity of her vision and her experience around addiction and supporting people through addiction was highly compelling. And we actually just followed on into Ali Health about probably 6 weeks ago at their seed stage. So they released a beta product, started getting some early users, showed some significant value in terms of how they're supporting users through this journey, brought on some key partners and brought on some early team members. So that ability to storytell to acquire customers or users, partners and team members is really exciting, and we're pumped about where that journey could go. Another one that's probably one of the more interesting but unique startups that we've backed is a company called Swoop Aero. So they they build autonomous drones in-house and utilize software to effectively move critical supplies from point A to point B. Currently operating on a global scale in remote communities, but the really exciting opportunity, which is just starting to kick off in Australia, is this deployment of autonomous drones in urban environments. So that's an example of a company that has amazing product utility, but what's also super exciting about that is this second order benefit of having societal impacts that genuinely change life as we know it and improve healthcare equity across the globe. So that's one that, super excited about as well.
Awesome. Yeah, I was reading something about Swoop Aero, I think delivering medicine to remote communities. So I think that's an exciting future for that company as well. Awesome. So thank you for that little good little intro into venture capital. I think in this next section, it would be good to go through some of the different factors that you look for when assessing a startup, and that's, I guess, what students can also take on board when they're doing the venture capital case challenge, how to assess the 3 companies that we're presenting to them. So yeah, it'd be good to hear from your end what the factors are and what are the key things you think about when assessing a startup. Cool.
So just to caveat before we dive into these 7 areas, every investment is obviously different. There's different perspectives and levers that you need to lean on when looking at a different company, looking at different companies, but essentially, we would see around about 800 companies a year, invest in between 4 to 7. So what this structure acts is just more of a methodical path of how to make an aligned decision and structured decision on when reviewing companies that fit within our mandate. So these are just a few of the criteria that we will look at. There's a few more, but this is just kind of a good skeleton to work off to do so. Cool. So just diving into business overview?
Yeah, sure, let's do it.
Alrighty. So business overview is essentially looking at the problem, looking at the solution and the value proposition. So fundamentally just getting super clear, what is the problem that's being solved? Do we think this problem is important and do we think it's valuable? Can we clearly articulate and resonate with that problem? So that's like the problem piece. And then thinking about the solution, it's thinking about how is the company going about solving this problem where the value proposition is not only valuable today, but it's valuable over time. So a practical example, looking at one of our portfolio companies, is a company called Aura, which is essentially software to help retailers solve retail crime and reduce theft that occurs within retailers, but then also using data networks to help police solve theft and crime within retailers. So that's kind of like the context. And then when you look at the problem is essentially retailers are under extreme market pressure from online retail. Competition is driving margins really thin, and theft is adding to effectively shrinkage, which is loss within retailers, which is $1 billion problem globally. So the problem is really clear. Shrinkage and theft is an ongoing problem, and margin erosion is also an issue there. So the solution, effectively, the value prop for retailers is that they can realize extra margin by reducing the amount of theft that they incur each year. So that value proposition using software, using data networks is really clear from a customer point of view. And then also it's one of those problems that we don't think that's going away anytime soon. And if anything, competition and pressure from online retail is only going to heighten. So retailers' ability to increase margins is going to become more paramount, and realizing revenue and margin from existing customers is far more valuable and sustainable than having to continuously acquire more top line revenue. So that's just an example of like business overview of a company from a problem and solution perspective.
Got it. And then how do you think about the product, the actual product that they're building?
Yeah. So again, this is like a very general umbrella view of product. Obviously, it's going to be extremely tailored depending on industry and company. But when we typically think about product, we'll think about it in terms of core initial product and then future opportunity. So what does that product roadmap look like? So going into this case, depending on the stage of the business, it'll be looking at, do they have a product in market? If not, if they're pre-product, what exactly is the product that they're doing and how does that solve for that value proposition that you mentioned in the business overview? And then you can kind of start to work through structurally what are kind of the unique levers within products. So the first could be around utility. So what is the value that this product is providing customers, and what is that kind of notable moment? It's commonly referred to as an aha moment, which is essentially the customer clearly experiences the value from the product at a defined point in time. And then from that moment onward, you've hooked that customer and you can retain that customer for a long time. So simple example, looking at Swoop Aero, that aha or that magic moment might be that first delivery where a hospital receives that critical supply that would have taken 10x the amount of time using land logistics transport. So getting really clear on when a customer would see product value is important. The second thing that we kind of would look at is differentiation. So when looking at the market, what products are currently in market, and how is this product or how is this company solving this or kind of building this product differently? And that's a really key point then kind of that leads into kind of a competition analysis there. The next is looking at a stickiness. So obviously, if you're going to all this effort to acquire a customer, you want your product to be there for as long as possible. And there's a lot of different ways that you can start thinking about product moats and why customers would never kind of churn. But essentially, a few things that you can start to think about is like, what is the switching cost? So effectively, is it a long sales cycle? Is it a long implementation cycle of a product that the customer is not incentivized to switch you out? Ultimately, the best product stickiness is just pure customer value in terms of customers just love the product beyond and have no reason to change, but it's kind of hard to ascertain pre-product. Another kind of stickiness or moat might be around network effects. It's something that we look for a lot within businesses, and it's something that you'll commonly see within marketplaces, social platforms, collaboration tools. So kind of jumping back to first principles, a network effect is essentially when a product or service becomes more valuable, the more people that are using that product or service. So a really simple example is Slack as a collaboration tool. The more people that are on Slack, the more valuable Slack becomes, because you can have more communication, streamlined conversations. The big thing when thinking about stickiness is it's one thing to have the attribute to do so. So you may have network effects present within your product, or you should, if you're, say, a networking platform or a collaboration tool. The key part is unlocking it. So that's when you start to think about, as a startup, what are the insights or signals that this company can really capitalize on a network effect, as an example. So I think depending on the stage that these companies are in the case, you really start to look for what are the attributes of stickiness. Is there any indication that's occurring, whether there's traction or not? And if not, kind of what's your view on whether they could potentially unlock that? And that could be a function of competition or a number of other things. So that's kind of assessing core products. Now thinking about future products, again, when you're really early, future product is going to just purely be a thesis and a plan. But it is a good insight into how that company is thinking about product value over time. So you can really start segmenting from a product perspective what they think is core now, what's the wedge that's going to win customers in their beta product, and what those features look like. But how does that product evolve over time? You could find this in the materials that the company gives you within the pitch deck, just through a simple product roadmap. But I think what's more interesting is when you have a chance to catch up with the companies, which I think we're doing as part of this case, is really starting to unpick how the product evolves over time. Obviously, the later you're investing, the more clarity there is around future products, and obviously the more feedback you're getting from customers, so that's an iterative cycle. However, it's good to just kind of see from the lens of the founders in the company how they think about that.
Yeah, makes sense. And in terms of the business model, how do you think about that, particularly at such an early stage when there's a lot of uncertainty?
Yeah, absolutely. So business model is essentially just how a business operates, how it acquires customers, and how it makes money. So again, early stage, a lot of things change, and the business model can change as well. So, but if you can kind of like structurally break through revenue model, so how does the company make money? Is it subscription? Is it transactional? Is it focused on upselling customers, or is it purely a volume game, just continually acquiring customers? You can get kind of a good feel as to how that impacts the rest of the business model. So if it's high contract value, then maybe the need to drive volume from a customer lens is kind of less so. But then maybe there's concentration risk that's starting to form with customers. So it's just getting a feel for how does the company make money and what form. Obviously, we love subscription based revenue models, as most do. And if it's transactional, then it's kind of looking at how can you get comfort that customers are going to continue to come back and spend with a high degree of velocity, so that you can get comfortable that revenue is not going to continually fluctuate or be overly seasonal and those kind of things. So that's just like starting point. And then diving into business model is also kind of looking at customers and getting a feel for who are the customers, who's that dream customer, and what do they look like. As I kind of touched on before, are they large enterprise deals where the sales cycle might be extremely long, or are they, is this a D2C cycle where you may be just going to customers at a high velocity, but knowing who that customer is and what's involved in acquiring them is important. That kind of leads to customer acquisition and how the company is thinking about bringing customers on board, what channels they're going to leverage, and what kind of feel they have for cost. So obviously at the pre-seed stage, if you're pre-product, pre-revenue, a view on unit economics around how much it's going to cost to acquire a customer is unknown. But thinking about the market and where they're playing in, what kind of competition exists around that industry, that's when you can start to get a feel for, okay, this is going to be a costly acquisition strategy, or you can get comfortable that their insight into how they're going to acquire customers is refined, essentially. And then I think from off the back of that, you can really start to piece together what largely what insight the team is giving you that this business model is going to be sustainable over time. So it's one thing to be able to acquire customers, but if you can't extract value and revenue out of them, then the business is going to really struggle to survive. So that's essentially how we think about business models.
Awesome, thank you for sharing that. Next on the list is market opportunity. How would you go about assessing the entire market the startup is tackling?
Yeah. So market opportunity is an interesting one, and I think you'll see within venture funds that they're always looking for the largest opportunity that's possible, and that's a function of this, power law rule that we follow, where essentially you'll find that most of the returns derived from venture capital funds comes from a minority of the portfolio companies within the fund. So naturally, the startups that are looking at the largest markets have, you would expect, the largest returns because they have the biggest market share to gain, and then have kind of the greater likelihood to really drive that power law. However, that's like a contentious, some contentious views around market opportunity, and there's a lot of debate over whether, like, how you go about thinking about markets. But essentially, at kind of the simplest form, it's how can you quantify or easily quantify what the size of this opportunity is? There's lots of different ways to do it, and to be honest, when looking at like total addressable markets, it can all get a bit crazy, and everyone just taking kind of finger to the air of what it might be and not a lot of science around it. So I think what I would recommend is err on the side of kind of understating. So an example, using Slack again, it could be really easy to just say the market opportunity for Slack is all collaboration tools, or the dollar derived of collaboration tools each year. And like, yes, potentially, but maybe a more interesting view is to look at the target addressable market, so the TAM, as a bottom-up approach. So how many companies globally are over a certain size of employees where collaboration is a key function, and that could be could it be distributed teams, it could be global companies. And then you start looking at, okay, how many employees are within that company? What's the average revenue that we would charge if it was a per seat model? And you start building this like total addressable market off the back of maybe a bit more science around who are the customers you're looking for, how many are out there, as opposed to just taking a full industry view over collaboration or future of work. So essentially, TAM is just sitting up what's that really big opportunity. And then when you're thinking about sizing the market, you really start to thin the funnel, and then maybe it's looking at the addressable market. So a more realistic view over what you're targeting in the short term. So that could be a geographical view, or that could be a certain industry type. So say for, when Slack was getting off the ground, maybe it's just looking at, we're going to target companies within APAC and that are under a technology banner, because we don't think the customer acquisition strategy for financial services is there yet. So you start to thin and narrow that funnel, and that addressable market starts to get a little bit more realistic. And then the obtainable market is kind of the really bottom of the funnel, which is when we consider competition in this space, what's a realistic market share that we can get to and drive, and then that drives our value in terms of a smaller market. Essentially, all this is trying to do is to just trying to get a landscape around how big is this market and how achievable is it that you can acquire a percentage of it. What I really think is the really critical part about market opportunities is thinking about timing and market momentum. So why is this solution important now? Coming back to the business overview, why is it important now, and why is it important in the future? And can the business ride any tailwinds within a market or technology development, whatever that may be, that makes this opportunity really start to accelerate over time, and really kind of create some acceleration to customer acquisition. So I think the timing and momentum piece is the really interesting piece, because most people will look at total addressable market pretty similarly.
Awesome. Makes sense. So you can almost have an idea too early and like the market might not be ready.
Exactly. And also to that, you might be creating a new business model, or you might not have a comparable company that you can look at in terms of their traction to kind of leverage or compare yourself against. So it can be difficult to actually start to think about markets rationally. So that's why it's always start to maybe just go on the side of caution and understate what that opportunity is.
Yeah. And then how do you think about the team, the actual people driving the startup? How do you assess what makes a good team?
Yeah. Team is obviously critically important, especially at the early stages of a startup's life. At a pre-seed round, you are really leveraging that this team can do that, they achieve what they're hoping to achieve, and there's not a lot of other data points that you can lean on outside of market alignment, context, opportunity, all those kind of things. But when looking at teams, I think the starting point is to think of why this problem, why are they solving this? Is this I was out with my friends last night, we came up with a really good idea, and then 2 months in it's going to get hard and we're going to flick this idea and I don't want to do it anymore? Or is it this is the culmination of someone's life journey where the opportunity to solve this problem is kind of hitting perfect timing, and that there's genuine insight that's going into solving this. So kind of look at our portfolio companies using Swoop Aero as an example. Swoop was founded by two incredible founders. One guy, the CEO, Eric, essentially was in the Air Force for 7 years working in Hercules aircraft, and his technical co-founder Josh was a mechatronics engineer, and I think he was also ranked as the third drone racing pilot globally at the time. So there you've got the connection of two people that have deep industry expertise, passion and insight into solving autonomous drones. Similarly, Manuri from HealthMatch, she was a doctor working around clinical trials. So HealthMatch is a clinical trial matching platform. And she saw the inefficiency and ineffectiveness within the clinical trial process and how that was breaking down selection and capability. So she was in a unique position to solve that problem. So I think that's the first and foremost, like, why these people, why now, why are they solving it, and what is their insight? But then it's also really starting to unpack, what is their intellectual humility like how transparent are they about what they do and what they don't know? Ultimately, when you're building a company, the future is completely uncertain. So getting some insight into how they think about things, how they hypothesize, how flexibly minded they are in terms of what they don't know, is really interesting to start unpack. But I think really spending time with the founding team is important. So obviously difficult to do within this case because you probably only catch up with the team once, but from our perspective, we love to build relationships over time and never think speed dating leads to good outcomes. So that's kind of our view on team.
Great. Yeah, super interesting to hear that. I think must be a pivotal part of that early journey. I think the next one on the list is one a lot of the finance students in the call might be interested in is valuation. How do you put a number on a company at such a stage?
Yeah, it's a great question, and valuation and price discovery doesn't have the luxury that public equities do. So private company valuation at the early stage, there's not a lot of science to it. There's more components and variables that you think about that you need to set early so that when the company grows, that valuation is rational to the future valuation for that company. I'll kind of unpack that a bit more, but I'd say there's two considerations, like, to keep this as simple as possible, two considerations to think about. The first is dilution. Again, depending at where these companies in the case are at in terms of their life cycle, dilution is a really important component, and dilution is effectively how much ownership how much of founders or existing shareholders ownership will reduce as a result of new money and new shares being introduced into the company. As a really broad rule of thumb, at the early stages especially, you wouldn't expect, or you don't want to see startups diluting outside of 25% as example. Shouldn't be really higher than that. So you'd kind of naturally see dilution as between 18% to 25% as a rough rule of thumb. And so how does valuation play into dilution? Essentially, dilution is just a numerator denominator equation. It is simply raise amount and post money valuation. So if you have an indication of how much that startup's going to raise, what is the post money valuation? Post money is the raise amount plus the pre-money valuation. That puts dilution in a reasonable zone. And why is that important? It just gives you kind of another data point to see, to kind of almost sense check whether the value of the company makes sense. And then when you're thinking about companies at the early stage, there may not be any revenue. So you can't do revenue multiples or comparables if you're creating a new business model within a new sector or whatever it might be. So what you want to think about is what is projected revenue over time, and what's the revenue goals or the forecast of the company. And does the valuation make sense now, so that when they go to raise at the next round, the valuation isn't going to balloon where it starts to become really irrational over time. So rounds sequencing tend to work in each round you want to increase the valuation, again, really broad rule of thumb, but say 2 to 3x. So if valuation's starting to tick up 2 to 3x at each future funding round, once the startup really starts to turn on revenue and monetize, does that revenue multiple start to sit within a zone that's broadly acceptable? So they're kind of 2 points to think about. Ultimately, valuation at early stage, there's no real science around it, but it's more just thinking about different levers that you can kind of get to a comfort level that makes sense for the startup now, but also doesn't cripple it in the future where, say, valuation is too high or valuation is too low and the founders don't own enough of the company to care.
Great, thank you for sharing that. I think when the case challenge is actually released, we'll also be sharing a few resources around how you can think about valuation as well. So if you're participating, you'll have that information as well. And I think we might quickly touch on the key risks before moving on to audience Q&A, which is starting to come in through Slido. So how do you think about risk management at that early stage?
Yeah, so I think one key rule with investing in venture capital or any asset class, the risk is always the same. You can only lose 1 times the amount of investment that you put in, unless you're short selling on public equities. So how we think about it is we more think about what are the uncertainties, what don't we know, and what can we get comfortable around, or what do we have a view on of the future of what that uncertainty looks like. Again, can't predict the future. There's so much that's unknown at early stage venture, but it's taking a view and opinion on what you don't know. And this is largely driven by the founders themselves in terms of you getting comfortable that they're really aware of their blind spots or aware of what they can't control. And then we also take kind of a view on that and kind of see whether we're aligned. But there's lots of different risks that could hurt or could limit a business's growth. So that could be platform risk, customer concentration risk, dependency risks. There's lots of different market risk, regulatory risk, lots of different things. So I think it's kind of case by case basis depending on the startup, but I think it's just calling out really openly what those uncertainties are and then seeing whether you can get comfortable around them.
Great. So yeah, I think that'll bring us to the end of the workshop today. Thanks for your time, Dan and Jess, and sharing the insights you gleaned from your experience in VC. And thank you also everyone for attending. For all the students in the call, registrations for the case challenge close this Monday at 6 p.m. You can register in a team of 3 to 4 or individually, and we'll put you in a team. If you have any questions, you can feel free to reach out to us either through our Facebook page, website, or even Instagram. Yeah, thank you again, the team at Folklore and everyone for attending.
Awesome. Thanks, everyone.
Thanks, guys.